Today, I want to talk to you a little bit about how retirement plans can affect your overall tax situation. I actually used to work at another place that held a lot of 401ks, so I'm excited to talk to you about this. So, let's first talk about the 401k. With a 401k, what this allows you to do is take money now that you're earning and not have it taxed right now, but have it taxed in the future when you actually use the money during retirement. So what happens is your employer will take money out of your paycheck. You can choose the percentage or dollar amount, and they will put it into your 401k plan. Now you can choose whether they pull that money out pre-tax or Roth. So with pre-tax, the money going into the 401k has not yet been taxed. So when you take that money out during retirement, that's when you pay the tax on it. If you're doing Roth contributions, the money is being taxed through your paycheck, it goes into the 401k, and then when you take the money out during retirement, it does not get taxed again. A lot of people will use the pre-tax money to defer their taxes till later because they believe that they'll have less income or be in a lower tax bracket later on. So for example, let's say that you make $100,000 a year and you put $20,000 into your 401k during the year. That would mean that you have $80,000 of income for the year that's considered to be taxable. Now, a couple things that go into this, there are some limits on how much money you can put into the plan. The first is for 2025, the limit on what you can put into the 401k is $23,500. And that's just for the basic 401k contributions. That's for pre-tax or Roth. Now, if you're over the age of 50, so if you're from 50 to 59, you can put an additional $7,500. If you're between the ages of 60 and 63, you can put an additional $11,250 on top of that $23,500. Or if you're over 64, it goes back down to that additional $7,500. This is called catch-up contributions. Usually with your employer, they will put some money into your 401k for you as well. They may match what you put in. So for example, let's say you put in 5%, your employer may put in 3% or 5%, just depending on how their 401k benefit works. These employer contributions will always be pre-tax, even if you are contributing Roth money. So definitely keep that in mind. Now, their contributions aren't going to help you in any way right now to help defer taxes to the future, as that's not deferring your income, it's just the employer match. One benefit that 401ks do have, though, is you can take loans from them. And this does depend on the company that you're with and who services the 401k. But a lot of times you can take a loan and then you pay that loan back through your paychecks. Now, when you're doing this loan, you're receiving pre-tax money and then you're paying it back with interest. The thing that's really cool about 401k loans, not that I necessarily recommend them, but you are paying interest on that loan and it goes directly to your account. You're paying yourself interest, not a bank. Now, if you're to leave the company and you have a loan out, sometimes the company will make you repay it, or they can continue having you do payments on that loan. Just depends on how they have all the rules set up. Now, if you default on the loan, which say you leave the company and you don't want to pay the loan anymore, the loan can default. Now, this does sound scarier than it actually is, but you'll no longer have to pay on it, and the amount that you still owed on the loan is considered to be taxable to you in that year. So it's like you had taken a distribution essentially. Now, on the other side, with talking about another retirement account, we have IRAs. There's both a traditional and a Roth IRA. So like we talked about with pre-tax and Roth earlier, pre-tax is the traditional IRA, where Roth money is obviously in a Roth IRA. These different IRAs have also different limits as well. The limit for 2025 is $7,000 for the year, or if you are 50 or over, the limit is $8,000. There are a couple limits on this though that we have to pay attention to. So for a Roth IRA, If you are married filing jointly, your income has to be under $236,000 for the year to be able to contribute to the Roth IRA. If you have a single filing status, it's $150,000. So if you're over these amounts, the Roth IRA is not the place to contribute as you can't. For the traditional IRA, this is a little bit different. If both you and your spouse have workplace plans, so 401ks through your employer, to be able to contribute to the IRA, you have to make under $126,000. Now, if only one person is covered, I believe that limit is $236,000. So a little bit different there. With the traditional IRA, there are a couple things or a couple ways that you can avoid the 10% penalty for early withdrawal. So if you withdraw before the age of 59 and a half, they have that 10% penalty, mostly to discourage you from using your retirement funds. But one way to avoid that is if you are purchasing your first home, you can take out up to $10,000 from your traditional IRA and not have the 10% penalty. Now keep in mind, you will still be taxed on that $10,000 because that money has not yet been taxed because it's in a traditional IRA. The IRS wants their cut, that's for sure. Another way to avoid that 10% penalty is to use the funds for higher education. And this is for paying for college, tuition, books, those type of things. Now, one thing that you also have to consider with these plans, with pre-tax 401k or with your traditional IRA, you will be subject to required minimum distributions, and those start once you hit age 73. That's what the IRS has set right now, if you are no longer employed. So the IRS says that you have to start taking money out of that plan because they want to start taxing your money, essentially. So you do have to watch for those. The money cannot just sit in the account forever. There's lots of different things that go into retirement plans and planning with them. This is something that it's a good thing to sit down with your financial advisor as well as your tax professional to go over how these can be beneficial to you. There are other limits in the 401k as well, that some plans allow you to contribute after tax money and convert it over to Roth. But definitely consult with us here at Pack Tax. We'd love to visit with you about this, and your financial professional as well, to make sure that you're using these in the best way possible. If you have questions on these, let us know. We're happy to help, and we'd love to visit with you. Thank you.